Well, I'm Joginder Rana. The topic of the day is curbing insurance mis-selling. Curbing insurance mis-selling. At the recently held State Bank of India Economist Conclave, Finance Minister highlighted that while bancassurance has improved insurance penetration, it has also led to mis-selling. Such practices contribute to higher borrowing costs for customers. So the RDA chairman also feels that there is a growing concern regarding bank mis-selling insurance products. Misrepresenting insurance as fixed deposits is one of the common type of mis-selling. Bank relationship managers often market insurance products as high return fixed deposits. So sometimes they also misrepresent them as short-term investments having a tenure of barely 3-5 years. Bundling insurance with loans is the another form of mis-selling. Means purchasing of term, property and other insurance is presented as a precondition for sanctioning of the loan. So the borrowers feel they have no choice but to buy. Worse, borrowers are sometimes sold irrelevant policies. Customers are sold a personal accident cover instead of a term life policy, which fails to fully protect the family from loan liability. And appropriate products for senior citizens are provided. Unit-linked insurance plans, deferred annuities, and guaranteed income plans are most often mis-sold to seniors. Sometimes these are sold as alternatives to FDI. The terms and conditions and risk of these products are not properly explained to seniors. ULIPs, which include a mortality charge, can severely impact returns of the senior citizens. The mortality charge goes up as age increases. So the nonsense that higher mortality charge will eat into the returns from ULIPs is not explained. Another common tactic is building unrealistic expectations of returns from products like participating plans. What is not made explicit is that returns and bonuses depends on various factors and are not guaranteed. Group health policies is also one of the areas. Banks often push policies under group schemes. These products often come with limited coverage. So the insured also cannot port the policy to another insurer for better coverage. And one is mode of premium payment. So regarding premium plans, the premium plans are sometimes falsely sold as single premium policies. When customers realize they need to pay high premiums yearly, many default. Then how to protect yourself? Borrowers should know that buying insurance is not mandatory for availing loans. Never feel compelled to purchase insurance as a prerequisite for loans or other products. Instead of buying a new plan, consider signing an existing life insurance policy as loan cover. If offered high and guaranteed returns, steer clear. Be cautious of offers that sound too good to be true. Verify their authenticity by calling the insurers. Always participate in pre and post issuance verification calls. Verify that the policy meets your requirement. If it does not, cancel it. Before purchasing health insurance, reviewing the coverage, sublimit, exclusions, portability, and other terms and conditions. Stick to essential policies only. Choose pure term insurance if you earn and have dependents. An immediate annuity plan for income needs. All customers, but especially senior citizens, must embrace online banking. This eliminates the need to visit branches and reduces the risk of becoming a victim. There are certain key mistakes to avoid. Do not treat a member of the bank's staff as a financial advisor. They do not have fiduciary responsibilities. Instead, they are under high pressure to fulfill targets. Never sign on the dotted line of a policy without fully understanding its terms and conditions. Do not purchase an insurance product without first evaluating your financial needs and goals. Do not get pushed into making a quick decision. Take the brochure home, read product details and understand them, or consult a trusted advisor before committing. Discuss an advisor. Because the life insurance industry is likely to recalibrate its distribution strategies following recent remarks by the Finance Minister and the Insurance Regulatory and Development Authority of India on mis-selling practices in bank assurance. So this shift could drive insurers to reassess commission structures, diversify distribution channels, and reduce reliance on banks, which currently contribute over half of the industry's premium income. So the warnings comes amid concerns about banks prioritizing insurance sales over their core banking activities and instances of mis-selling, particularly to elderly customers. The mis-selling has contributed to declining persistency ratios, measuring policy renewals, indicating customer dissatisfaction and early policy lapses. Share of insurers heavily reliant on bank assurance, such as SBI Life and HDFC Life, fell by 2 to 4% after the Finance Minister's remark. Both drive over 60% of their premiums from their banking partners. In contrast, companies like ICICI Life and Life Insurance Corporations, which depend less on bank assurance, face comparatively lower impact. So the industry is already exploring alternatives. Direct channels and brokers are gaining traction with direct distribution, reporting a compound annual growth rate of over 20% among private players in recent years. Agency models and corporate agents are also being considered, especially for underserved segments. However, reducing dependence on bank assurance, which contribute 55% of the life insurance industry's rupees 3.5 lakh crore premium base, presents challenges. Bancassurance remains a cost-effective channel combining banking and insurance services efficiently. Insurers may adjust commission structures to discourage the sale of high commission products that are prone to mis-selling. So while a significant reduction in mis-selling may take time, the regulatory and market push is expected to improve transparency and customer-centric practices across the life insurers. The Indian government is planning to amend insurance laws in the ongoing session of Parliament to facilitate a unified license for insurers and raise the foreign direct investment limit to 100% from 74%. So So a single license for insurers and higher FD limit could boost investments and improve insurance penetration in the country, which stood at 3.8% of GDP in 2023. So a unified license or composite license will allow insurers to provide life, general and health insurance under a single entity. Currently, life insurance companies cannot sell products such as health insurance, while general insurers are allowed to sell products ranging from health to marine. So the proposal for a unified license was first suggested last year by the Insurance Regulatory and Development Authority of India. The country's insurance regulator. So a panel of lawmakers had backed the idea of what called for adequate capital and solvency requirements for eligible entities. Now say the capital requirement for insurance regulator's ambitious project Bima Sugam, an online marketplace to buy, service and sell insurance products, has increased to rupees 500 crore from the previously envisaged rupees 100 to 200 crore. So during the recent discussions, it was found that the insurance companies are informed of revised capital requirement for Bima Sugam, amounting to rupees 500 crore over 4-5 years. Of this, rupees 330 crore must be provided immediately, with the remaining rupees 170 crore to be contributed after 2 years. So Bima Sugam India Federation, a not-for-profit entity backed by the Insurance Regulatory and Development Authority of India, will house the Bima Sugam platform. This initiative aims to democratize insurance in India and has the potential to become the first of its kind globally. This single window digital platform will serve as a comprehensive marketplace where consumers can compare, purchase and manage insurance policies across life, health and general insurance sectors. This Bima Sugam is a part of the Bima Trinity, which also includes Bima Bistar, an insurance product, and Bima Vahak, a women-centric agent force that will sell this product on the Bima Sugam platform. All insurance companies will have equal shareholdings in the venture. Ernst & Young has been engaged as a consultant to execute the Bima Sugam initiatives. Ernst & Young has prepared a business plan approved by the board of directors of Bima Sugam. According to this plan, the company will require rupees 500 crore of capital over the next 3-4 years. Of this, rupees 330 crore will be brought in immediately to cover the first 2 years, while the remaining 170 crore will be raised after 2 years. So all companies with shareholding in Bima Sugam will contribute 330 crore, with rupees 165 crore each from life and general insurance players. So this is required for technology enablement, and Bima Sugam is also seeking office space in Mumbai. So the discussions on capital requirement were held during the Bima Manthan. Now Bima Sugam is being hailed as a game changer for the insurance sector, as it is expected to facilitate the sale of a wider range of products and enhance insurance penetration in the country. So payment for these products will be processed through the unified payment interface, and underwriting by the prospective insurance companies will occur immediately, generating digitized policies that will be sent directly to the customers. RDI has not provided a specific timeline for the platform's launch. Our industry insiders anticipate that the Bima Sugam will go live in the first half of the next financial year, that is Feb 5/26. In October, the IRDA stated that the implementation of Bima Sugam is in advanced stages. So the appointment of other key management personnel for Bima Sugam is also nearing completion. And soon we should have the entire leadership team in place. We are in the process of onboarding the system integrator, the technology service provider, and hopefully we will witness the first phase of Bima Showrooms launch soon. Thank you.